Hello and welcome to the Bulletin with UBS on Monocle Radio. Each week, the sharpest minds and freshest thinkers in finance take you beyond the numbers and hype, right to the heart of the big issues of the day. This week on the programme, we're asking, is it the right time for private markets? Our special guest this week is Richard Huang, Alternatives Investment Specialist at UBS, and he's here to answer that question, to explain why private markets can make sense for longer-term portfolio positions held by investors who can tolerate their relative illiquidity, and to tell us about 3 key drivers for putting your money to work today in private markets. Richard, well, a warm welcome to the show. Great to have you with us. Let's just start off with, I guess, the obvious opening gambit. Just remind us, when we talk about private markets, what do we mean exactly?
Well, private investments, basically refers to assets that are not traded on public exchanges. It could cover, different asset classes, be it equity, credit, real estate, infrastructure. So it do cut across, a number of different asset classes. And given that these are investments that are not publicly traded, they're typically less liquid and are better suited for long-term investments. When it comes to the typical kind of investment horizon, we're talking about tenure of normally 7 to 10 years or more.
Well, yeah, let's talk about that. And it's interesting, as you say, there is the illiquidity question, but it suits a longer-term portfolio strategy. Just tell us a little bit about the attendant benefits that come from that long-term view, the time horizon you've just mentioned, Richard. Presumably what we're thinking about, smoother valuations over time, higher returns potentially also?
Yeah. So, private assets do offer quite a few distinct advantages to investors. The first being allowing them to access a broader opportunity set. Especially with the likes of SpaceX, the likes of OpenAI, deciding to stay private for longer. And then through the private markets, investors can gain access to these unlisted companies that are unavailable in public markets. As you have mentioned as well, it also provides the potential for higher returns by allowing investors to capture the so-called illiquidity premium. And then finally, it also helps them kind of smooth portfolio volatility by dampening the impact of short-term market sentiment and flow swings. But of course, as mentioned earlier as well, there's this risk associated with these instruments as well, and illiquidity is one of them. And when investors are deciding on an allocation on this asset class, always need to take into consideration of their own liquidity needs.
Well, yeah, and we'll maybe come back to some of the attendant risks in a moment. But let's talk a little bit about recent developments in the private market space, Richard, and why that is making this maybe a particularly interesting or compelling area for investors. You mentioned a few of the different asset classes. Maybe we should go through asset class by asset class, but just give us a sense of kind of why the time is now, if you like.
Well, given the long-term nature of private investments, timing it's less of an issue. But that aside, we do think the overall backdrop is favorable for a good number of different private investments. And if that's okay with you, maybe we start with private equity.
Absolutely, yeah. Give us the private equity picture, because I guess this is an interesting one. We talk about momentum, but there's maybe a broader opportunity set behind that.
Yeah, sure. So, given private equity, it's among the various kind of verticals, it's the largest contributor to the whole kind of private market universe. We do see quite a good number of reasons for optimism in the private equity space. The first being the macro backdrop being supportive. The economic growth in US and more broadly in developed and in emerging markets as well continue to be fairly resilient. And we've seen this kind of favorable economic backdrop translate into robust earnings for private companies. Secondly, we've also been seeing deal activity returning in global capital markets. Part of it has to do with just overall risk that investors have around various factors, be it tariffs, be it interest rates. These sort of concerns have been dialing down. And of course, what we've been seeing is rounds and rounds of monetary easing through central bank rate cuts. And what that has translated into, it's an increased number of M&As, increased number of IPOs, and this it's relevant for the PE sector, given that allows for them to exit investments that are previously made and allow for them to deliver on increased distributions to private equity investors as well. And then finally, for investors in public equities, valuation, it's topical. It's certainly one of the areas that it's warranting a bit of concern. but valuations remains in pretty attractive levels in the private markets. They continue to trade at pretty notable discount versus their public counterparts. So that's another key reason to be optimistic of private equity investments as well.
Yeah, an excellent summary. Let's switch our sights and talk a little bit about private credit. I think this is really interesting, Richard, and maybe there's a need for ever greater selectivity. Reading a recent note from your colleagues about this space, but give us maybe a few of the headlines in the private credit space.
Yeah, sure. So, let me just start by highlighting the conclusion, the rating that we have on the direct lending on the private credit space. It's a neutral rating. So, as you can tell, we are not as optimistic in that part of the private market versus say, equities or real estate or infrastructure. Part of it has to do with the increased bifurcation that we've been seeing in the market, the state of health in terms of credit fundamentals that we've been seeing between large and smaller companies, between the top end and the bottom end of the market. That trend continued to diverge. And of course, that speaks towards, the potential kind of credit risk associated with this segment has edged higher. That it's on the risk side. And from the return point of view, the rate cuts that central banks all around the world have been delivering, together with the credit spreads that have been tightening, not just in the direct lending space, but basically throughout the entire credit market, meant that direct loans, which they are floating rate in nature, are delivering on lower returns versus what it offers, call it a year or two ago. And given the expectation, it's that rates, there's still scope for it to be cut further, and spreads unlikely to rebound in a meaningful way. We think looking out in the next, call it 12 months, we continue to think returns from direct lending, from private credit will moderate from here, and hence our neutral rating on a space. And when it comes to what it meant for investors, I guess it depends a lot on their allocation in this specific asset class. For those that are underallocated, for those that have hardly any exposure to this asset class, then we continue to think it's potential investment that could offer attractive income, that could offer diversification benefits. But for those that are overallocated, then diversifying into other private market strategies makes quite a lot of sense to us, particularly into PE or infrastructure, which and real estate, which are, the kind of verticals that we are particularly optimistic at the current juncture.
Well, yeah, you set it up perfectly. Let's talk a little bit about the infrastructure and real estate class here. Further sources of diversified income, which you've alluded to already. But yeah, just recap why UBS continues to see that longer term value in particularly this private real estate space, Richard.
Yeah, I think one thing that we highlight it's critical when it comes to managing your exposure in private markets, it's diversification. So that it's one of the key reasons why we continue to favor infrastructure and real estate investments as well. Because first, we felt like it provides an additional layer of diversification into one's portfolio, be it for the overall portfolio or just for the private markets positions. Secondly, it also provides inflation-linked income as well, because historically we have seen cash flows from real estate or infrastructure investments tend to be positively correlated with inflation. And given the kind of stickiness that we've been seeing in inflation, not just in the US, but all across the world, that's another key reason why we are in favor of these asset classes. And on top of that, these are also investments that ride on a number of long-term secular trends. To start with, AI, it's one kind of powerful tailwind that could benefit various types of infrastructure investments, given it creates the need for increasing number of data centers, telco towers, fiber networks. And of course, another long-term secular trend that we've been seeing playing out all across the world, it's the reshoring of supply chains that kind of kickstarted following the onset of COVID. That trend continues to play out. And as we start to see more supply chains being onshored back onto particularly developed markets like the US or Europe, that creates a lot of demand for additional infrastructure build out as well. And then finally, the thematic of energy transition hasn't gone away. We continue to see the world moving towards clean energy. Carbon net zero continues to be a long-term ambition for governments all around the world. And that's also another, long-term secular tailwind for infrastructure investments.
We mentioned a little earlier illiquidity as perhaps, sort of primary risk factor, or certainly something for canny investors to be mindful of. So much of what you've said talks about why recent developments in the particular corners of this private market space do provide this interesting entry point. But let's caveat it. What are the risks? Illiquidity, certainly one. Smart investors, they're interested in this space. They're kind of sold on the picture you've painted. But what else do they need to be aware of if we're looking at potential downside?
There's certainly, quite a lot of potential benefits that private investments can offer, but there are no free lunches. We always need to be aware of what are the potential risks that are associated with these investments as well. And I think it's critical for investors to take those in mind before they're deciding on what sort of allocation and what sort of commitment that they want to have in the private market space. So in addition to illiquidity, which I think we've highlighted quite a few times, there's also the blind pool risk, which it's something that it's particularly relevant for investors that are interested in making an allocation in the private markets. A lot of these investments often require investors commit capital without having perfect knowledge into what are the specific underlying investments that they're deploying into. That is just a typical feature for a lot of the private market investments. So that's something that they certainly have to be aware of. The fees, whether it's management fees or performance fees, tend to be higher for private market investments versus publicly listed investments because of the higher active approach that we expect the private managers to kind of spend on caretaking these investments. So fees, which tends to be higher in private versus public markets, it's another kind of risk, another area that investors need to be aware of. Disclosure, just given the private nature of these investments. And then finally, there are also, for a lot of these private market investments, they tend to be leverage. Not for all, but certainly a good number of these private market strategies, they tend to be leverage involved in crafting the portfolio, in crafting the investment. So, that it's also another kind of layer of risk that investors need to be aware of. As I said before, they consider making an allocation on these investments.
That's Richard Huang, bringing us to the end of this edition of the show here on Monocle Radio. Listen again and subscribe to Monocle Magazine at monocle.com and discover more and find out how UBS can help you at ubs.com. This is The Bulletin with UBS on Monocle Radio. I'm Tom Edwards. Thanks for listening.